Greetings, my fellow financial ninjas. The topic that I'm going to talk about today is how to pick investments in your 401k. Whenever you join a company that offers a 401k, typically it is offered by some third-party brokerage companies such as Vanguard, Fidelity, etc. And these companies offer a pretty comprehensive list of different options for you to make your investments. This could be in the form of target dated funds and blended mutual funds and um, bond funds and money market funds and so on and so forth. So how do you pick the right investment? And that's what I am going to talk about today. Remember, I am not a financial planner or a financial advisor. I'm just going to share what worked for me, and if you are going to make your individual decision on how you want to invest, please consult with a financial advisor. So let's get that legal disclaimer out of the way and kind of jump into the topic. As you can see here, there's a number of options in my Fidelity account. This is the company I used to work for, and this is the old 401k. And just to give you an example of all the different options available, as you can see, there's the stock investments, blended funds, and there's so many different options. So how do you make the determination on what are the types of investments that you choose from this list? Now, let's discuss the criteria for picking the right type of investments in your 401k. Now, as I mentioned before, there's a variety of different options offered by different companies. So what I may have in my 401k option in the Fidelity account that I just shared with you, you may not have it. It might be something different, but what you will find is there is a flavor of some kind of index funds or target dated funds that are in there that could be similar. So the goal here is to identify those funds and make your investments. The basic criteria, in my opinion, is that you should keep these investments, simple. Try not to, overdo things. There is definitely a method to the madness, so to speak. So what you do not want to do is go with whatever default investments that have been selected for you. Because what happens is when you start a new 401k plan, it either goes to a money market fund or some sort of a target dated fund, and a lot of people just don't even bother checking what are the options and trying to look for the best options. And this video will precisely target that part. You wouldn't have to spend more than like 15 to 20 minutes on all your different options, and then basically make your determination on what would work for you. I am the biggest fans of index funds, and the way I distribute my investments is large cap US index fund, mid cap US, small cap US, and finally the international large cap. So those are the four investment that I recommend, and you should basically put in 25% each. So your exposure would be 75% to the US market and 25% to the international market. Now, what may end up happening is that you may have multiple options for let's say large cap US or large cap international. Then how do you make the determination which is the one that you should be going with? And that's where the expense ratio comes into picture. The expense ratio is basically how much money is spent on managing that particular investment. So this is the fund manager fee and all the other expenses that are related to that particular investment. And obviously the lower the cost, the better it is, the more money you put in your pocket. I like the expense ratio to be below zero point 0.1, because if you're putting your money in index funds, really there's not much that needs to be done by the fund manager. You're just indexing yourself to either a large cap or a small cap index. So in that case, the expense ratio should be really low. Anything over 0.5, I would not recommend. I think it's just too much, and unless there's some sort of a spectacular returns delivered by that fund manager, there's no reason for you to pay the additional expense ratios. And what I have seen and what the research shows is that the index funds have been proven to be outperforming most of the fund managers. So I would recommend going with the index funds with the lowest expense ratio. There's a great tool called as Personal Capital, and I'm a big fan of that. This particular tool lets you track all your investments. It gives you a snapshot of your current net worth, and not only that, it also gives you an investment analyzer that kind of does a analysis of all the different options that you have, and then it also does a calculation of the expense that's going to be incurred by you on your investments over a period of 20, 30, 40 years, and that will give you a good idea on how much you're going to end up spending money for your selected investments. So I think it's a great tool, and I think everybody should sign up. I will put a link in the description. If you sign up, I will get $20, and you also get a $20. It's a promotion that they have. So if you want to go ahead and sign up and get it, it's free. It's completely free. You don't have to pay anything for it. The next criteria is your risk tolerance. Now the options that I recommended are all stock options. So your portfolio is 100% stocks. And traditionally it's considered a risky portfolio because of the fluctuations in the market. However, my opinion is that if you are in the long term in the market, there's no need for you to be fearful of stocks. So if you're going to be in the market for, let's say, 20-25 years, there is no harm in being 100% in stocks. However, if you are a little bit risk averse and you want to reduce your risk, then what you can also do is put a little bit of money in your money market fund or bond fund. So that the money market fund is basically cash, and that's not a bad thing to have. Maybe like 5% or 10% of your total portfolio in like cash, so that when the market does crash, you can deploy that capital. You can also have some sort of bond fund, like a US bond in your portfolio, maybe like 10 or 15%, and the bond funds are supposed to be more stable compared to to your stocks. So the risk tolerance also makes a somewhat of a difference. In my case, I'm not worried about the risk. I want to be 100% in stocks and make sure that I get maximum returns on my investment. Then there are target funds. So what are target funds? So basically, target funds are the funds that have a certain ratio of investments based on your retirement date. So let's say if you're going to retire in another 20 years, so you can choose like a 2039 target date fund, or if you're 25 years away from retirement, something like a 2045 target dated fund. So what happens is as you get closer to retirement, the investment changes from stocks to bonds, which means it becomes more and more conservative. I'm personally not a big fan of target dated funds because I think they are way too conservative. I would rather have all my money in stocks and try to maximize my returns. Here is a snapshot of the investments that I have in this particular 401k. I used to work for this company years ago, and I have kept that same 401k all I do is I rebalance my portfolio every year, like in January or February. So here you can see I have the Vanguard 500 Index Trust, which is the large cap, the mid cap right here, the small cap, and finally the international. So as you can see from the percentages that international has not done that well. However, the small cap has done really well. So what I'll do is I'll let this run till the end of the year, and then there is a tool that is offered by your broker that where you can adjust these investments. So what I'll do is probably in mid-Jan or early February is change these investments back to 25% each, and then let the market do its magic. The reason for doing the rebalancing is you don't want your investments to get lopsided. So if I continue with this same investment without rebalancing, what might end up happening is I might have way too much exposure towards one kind of investment, and what I would like to do is balance this so that it is 25% for all the category, and so whichever category does the best for that particular year, I get the maximum benefit from it, because not every category is going to do the same year on every year. As you can see, it's a very simple strategy, but it's a very effective one. In fact, if both husband and wife decide to fully fund their 401k and make the maximum contribution to the 401k plan, within a span of 10 years, you can have a nice nest egg of 600 to 700,000, assuming around 8% return, which is what the S&P 500 index has returned over the past 30 odd years. So that's about it. Do let me know what you think about the strategy in the comments. If you like the video, smash that like button. Subscribe to my channel. If there's any requests regarding a certain topic that you want me to make a video, do comment, and I will see you in the next video. Bye bye.